Omega, thanks very much for joining us. There's been a lot of discussion around debt at the moment. Where do you think we are as an industry in terms of debt? Should we be, looking or preparing for a period of distress?
So last year, I think it's fair to say there was a degree of retrenching by most of the lenders for obvious reasons. And we started this year, I think, with a sense of cautious optimism, particularly when the government announced their roadmap going forward. And now, in fact, we've seen that lenders are really quite busy. So it's certainly the case that the markets are open. And there's also a sense that it's a good year to originate debt. So we've seen a fair amount of capital that's been raised specifically to target distress, but also more generally debt strategies. I think it's also the case that as a whole, the market is more resilient than, say, just after the last crisis, probably as a result of the variety of lenders that now operate, lower market average LTVs and probably less covenant light loans than we saw last time round. But obviously that's just an average position. It's not addressing individual loans. And by some estimates, there's still a funding gap in the market. So if we take into account market value decreases and expected lender appetite, that could be as much as 17% of outstanding loans. And so, yes, I do think that we're going to see a period of distress. Last year, there was a degree of stasis. The government provided a huge amount of support. So 330 billion of guaranteed loans, a moratorium on forfeiture, restrictions, winding up petitions, business relief and VAT deferrals for hospitality. And we also saw most of the lenders really showing a degree of forbearance last year. But now, of course, we're 1 year into this and we're expecting to see more refinancings and less extensions. And therefore, once this stasis starts to unravel, we'll see more distress. But I think it's also the case that it's not going to be a one size fits all. There's definitely a divergence across different asset classes. So some assets will likely fare better than others from a finance perspective. Logistics, build to rent, life sciences, on the one hand, being very popular still, and retail is an obvious example of an asset class that will likely see more distress. And then somewhere in the middle, office and hospitality that might require a period to stabilize. So yes, I think more distress for the real estate market from a finance perspective, but really focused on certain asset classes. And more lenders will look to the sponsor that is underwriting the loan. And when they're underwriting the loan, and in particular, consider whether that sponsor has equity in case of a worst case scenario, and also the flexibility to adapt their business plan.
What type of funding is out there to recapitalise any of these distressed debt situations, Omega?
So we've seen lots of alternative lenders, debt funds, private equity, raise capital in particular to focus on two strategies. Firstly, acquiring non-performing loans, and secondly, to recapitalise existing positions. And some of these strategies are asset class specific. Hotels is a good example of that. So with the dry powder in the distress funds and the expected distress we were just talking about, on our side, we're expecting it's going to catalyse a secondary debt market. So we're going to see more debt trading in the secondary debt market of non-performing loans as a way to resolve the debt, help lenders, banks remove problem loans from their books. We're also seeing some other interesting strategies, so innovative asset-backed loan strategies, which allows sponsors to source finance against balance sheet assets and cash flows, which might provide an additional source of liquidity during a repositioning. And I suppose from my perspective, most interestingly, professionally, is the capital that has been raised to help with the more complex capital restructuring situations, to support schemes and balance sheet restructurings. In fact, after the last crisis, I did a fair amount of work helping sponsor clients in discounted payoff situations to secure financing to buy back their own loans, typically when their loans had been sold in a big portfolio, in return for retaining management and development fees and an equity kicker to incentivize them going forward. And in fact, this more complex capital or complex situations is the rationale for one of the strategies we have at Mischcon Rebuild, where we're looking to bring our legal expertise in restructuring and finance together with leveraging our network as appropriate of capital and asset managers to really help create a platform for these more complicated turnaround plans. So yes, more distress out there, and with the proliferation of funding solutions, one of the challenges is going to be navigating the market to find the right capital for each particular finance situation.
There's been a lot of discussion around that distress side, and it'll be interesting to see how that plays through in the UK market. Thanks for joining us, Omega.
It's a pleasure.